about 5 ways to take money out of your limited company, and the order that you use them in can save you thousands of pounds a year. Most directors only ever use 2 of them. Stick around to the end. I'm going to talk you through all 5, what they are, what they cost, what they're worth to you, and the order I'd actually use them in. Hi, my name's Sam, and I'm the founder of Ascenso Accounting. Most business owners only get to speak to their accountant once a year. I think that's rubbish, so I'm setting the new standard. Let's start with the one that everyone's heard of, salary. The trick with a salary is that, yes, it's tax deductible, but that doesn't mean you should pay yourself loads to extract a higher amount out of the business. There is an art to it. 26, 27 tax year, how I pay myself as a sole director is I pay myself a salary of £12,570. I pay myself that salary because that is in line with my personal tax allowance for the year, meaning I pay no income tax on that salary, but I do get corporation tax benefits. Because I am a sole director and I'm currently the only employee internally in my business, I don't therefore qualify for something called the employer's NI allowance. So while on that salary, I don't pay any employees' national insurance, my company, Ascenso Accounting Limited, will pay some employer's NI. The reason the company pays the employer's NI is the threshold for paying employer's NI is £5,000. So if I had another employee in the business, I would qualify for the employer's NI allowance and not have to pay this amount. But everything above £5,000 that I have as a salary, the company will pay 15% national insurance. Over the course of the year, it works out just over £1,000. However, having that salary, the £12,570 as an expense in my business will mean, depending on my marginal rate that I pay corporation tax, 19% to 25% or somewhere in between, I will save corporation tax of around £2,400 up to just over £3,000. So as you can see from that, the corporation tax savings over the year outweigh that employer's NI that the company will pay, meaning it is beneficial. Having that salary of exactly £12,570 is really beneficial to me as well as an individual because it is right on the threshold of which I pay employees' national insurance. And what that means is I don't have to pay any national insurance on that salary as an employee, but I am called something known as a deemed contributor. So I'm getting one of my qualifying years towards my state pension, which when I'm at that age, I'll be really grateful for. You might be watching this thinking, like, I can't live off 12,570 a year, so what's the crack next? Well, next comes dividends. How I pay myself is I have that salary of £12,570, and then I top up the rest with dividends. Everyone gets their first £500 tax-free. After that, you've got 3 different tax rates. Up to £50,000 of total income. So if I have my salary as 12.5, the difference between that and 50,000, I'll pay dividend tax at 10.75%. Everything over 50,000, the dividend tax rate jumps up to 35.75%. If you are an additional rate taxpayer, so your total income is over £100,000, then every £1 dividend that you take out over that £100, every £1 dividend that you take over that £100,000 limit, you'll pay tax at 39.35%. That jump seems really big, right? When you go over 50,000, it jumps to 35.75%. But compare that to having a salary, being in employment, or taking out a bigger salary of your business. Your income tax would jump up to 40% and the national insurance would be around 2%. So you're comparing like 42% income tax that you'd pay to the 35.75%. The one thing to remember with dividends, and so many people forget this and it can get you in some really sticky situations, is that dividends can only be paid out of something called retained profits. If your business hasn't generated the profits, you can't pay yourself a dividend. A dividend, by definition, is literally a distribution of profit. Next one up is pensions, and this is the one that does more work than any of the options that I'm going to talk about, and almost nobody uses it properly. So your company can pay directly into your personal pension by making an employer contribution. When this happens, two things happen at once. It's tax deductible for your business, so it literally reduces your profit on paper, meaning you pay less corporation tax. And then two, it's going to grow inside that pension pot. That pension pot is being invested in all sorts, and over time, you would hope to get that appreciation in value at the point in which you need it. Compare that method of extraction to dividends. I mentioned before that dividends by definition are a distribution of profit. So you have to have made the profit, paid the corporation tax, and then when you take the dividend out, you pay tax on the dividends. If you're already taking what you need out of the business through salary and then dividends, and you have excess profit left in the business that you have no short-term plan of maybe needing, then pension contributions can be a really tax-efficient method to extract money from your business to help your future self. The trade-off is pretty obvious. You can't touch that money until you hit retirement age, which for accessing your private pension currently is 55. A lot of people have negative connotations to pensions at the moment because of this. The trade-off is obvious, right? You can't access that money until you hit retirement age, which in the UK for accessing your private pension is 55. There's something to be said for higher profit companies, because when you're at a level that your profit on paper for the year is over £250,000, you'll be paying corporation tax at 25%. Now, if you have excess profits in your business and you do want to contribute into your pension, the tax relief that you'll get through your business will be at 25% also. Next one up is directors' loans. And this is something that gets people into bother all of the time. Again, I'll state dividends are a distribution of profit. People have this confusion that if they have money in the bank, that must mean that they can be tax efficient and take dividends out. But let's say you're in year one of your business and you take out a loan or you get some investment into your business. All of a sudden you're cash rich, but your business hasn't generated any profit. Therefore, you still can't pay dividends. So people have this confusion. And what happens is when you take money out of the business and you don't have the profits to declare a dividend, your director's loan account goes overdrawn. If this overdrawn director's loan account isn't paid back within 9 months, you'll pay Section 455 tax, which is a withholding tax. You'll essentially pay 33.75% on the balance that you're overdrawn by. Now, when you're able to clear this overdrawn director's loan account, either by going profit generating and being able to declare a dividend in the future, or physically paying that money back into the business, you do then get that tax back. But it's a situation you don't really want to find yourself in. The other thing to consider, and loads of people forget about this as well, is if your director's loan goes overdrawn by more than £10,000, this can be deemed a benefit in kind because you're not paying any interest on that loan potentially back to your company. And because your company is a completely separate legal entity to you, you as an employee of your company is having a benefit of having a tax-free loan. HMRC don't look very favourably at this, and you can both incur income tax and your company can incur employer's national insurance. So my opinion on directors' loans are a short-term bridging gap. It can work really well. If you've got the profit in the business to declare the dividend retrospectively and clear that director's loan, it can work great. If it's more of a longer-term approach for you, it can be expensive and really risky. The last one that I'm going to talk about are benefits and expenses that can be claimed through the business that so many people miss. These things individually don't move the needle like the salary and the dividend sort of tax strategy does. But when you know everything that can be squeezed, they can make a really big difference compacted. They can make a really big difference compounded. So we've already covered pension contributions, right? So that's really good. Next thing being trivial benefits. So you can reward yourself. Gifts worth up to £50 per gift, and each director gets a £300 threshold for the year. I have had a client in the past turn around to me and say they bought themselves a lovely coat, which was more than £50. Unfortunately, the whole thing then couldn't be deemed a trivial benefit. It needs to be under £50. Next one that is really good is mileage, and so many people forget about it. Just because you maybe spend the majority of your day sat at a desk, there's no way you're telling me that you don't get in your car for something business related at some point, whether that be the occasional client visit, going to visit a supplier, going to a networking event. In the current tax year we're in, you can claim up to 10,000 miles at 55p per mile. Every mile over that 10,000, you can claim at 25p. So when you think of that over the course of the year, that can add up to a significant sum that you can then draw out of your business tax-free because you're reimbursing yourself. The next one being professional subscriptions. Now, if you pay for these privately, so outside of your company's bank account, you can reclaim these from your business also. So if you have to pay something to a regulatory body because of the industry that you're in, this is completely fine to reimburse yourself back through the company. The last one being home office costs. So there are two ways you can go about this. HMRC either give you a fixed allowance of £26 a month. Now, you've got to actually be working from home, but if you do admin work from home, this is fine to put a claim through. The other option to compare with that £26 a month is you actually do a longer calculation and you tot up what your monthly outgoings are. You then go, okay, there are 5 rooms in the place I live. I use one of those rooms for business purposes. I work X amount of days a week, I work X amount of hours a day, and you work out essentially a ratio of your monthly outgoings. When you have that figure, you then compare it to the £26 a month. If that one's higher, that's your justification as to why you've claimed that higher amount, because you've done that full calculation. I've already mentioned that individually, these things don't move the needle too much, but stacked over the course of a year, that's a decent chunk of change that's yours to claim. And most directors just forget about it. So if you were to ask me the order that I'd use these 5 things in, the first one to consider is salary. As I said, I take a salary of £12,570. Depending on your profits and where you're at, you should consider doing the same. Number 2 would be to claim all of the expenses that I pay for personally back from the business. I mentioned professional subscriptions, mileage, use of home as office, trivial benefits, any of them. Now, number 3 would be dividends. So I do a budget for myself personally to understand what my out wants and my out needs are. When I sit down and run that exercise, it spits out a number at the bottom that I reasonably need to take out of my business to not only survive, but enjoy what I want to do each month. You should consider doing the same so you understand actually what you need to take from the business to enjoy your life. When you have that number, you can then plan how many dividends or how much in the way of dividends you need to take out from the business each month. In 4th place, I'd consider pension contributions. So you've taken your salary, you've reimbursed yourself for the expenses, you've topped up with dividends for the amount you need to take out each month. If you have any excess profits left over in the business that you're not planning to spend in the short term, you should consider siphoning some of that money away into a private pension. It's great for you long term, and you'll also save corporation tax in doing so. Number 5 would be to leverage your director's loan account. Remember, please just use it as a short-term bridging solution. Don't use it as a long-term approach, because again, you can get yourself in a right mess. This order is how I think of things, right? It depends a lot on your personal situation, your personal finances, your company's profits, how much you actually want to extract from your business. If you are doing things in a certain way at the minute and you're not sure whether it's the most tax efficient option, please just drop me a message and we can sit down and run through where you're at and perhaps put something together that is more in your favour. See you in the next one.